Welcome, everybody, to the 2023 Outlook, Finding Balance. I'm Brian Bohnsack, Senior Vice President of 360 Financial, along with Mike Rogers, our President of the 360 Financial, and we'll be guiding you through this webinar for over the next hour or so. Our topic today, as you can see, is recognizing our 2022 imbalance as built up in this economy and setting ourselves up for what's next in our economy and our markets, trying to find our way back to maybe a steadier ground, even though we might have some adjustments continue over the next couple months. Again, throughout this webinar, we'll be taking some questions. So go ahead and down in the chat section, put in your questions, and we'll get to those throughout this webinar. We'll also have some time at the end of our webinar to ask some more additional questions. And also at the end of the webinar, we'll have a few more minutes that you can stay on, learn more about 360 and the services that we provide our clients. So stick around for that. I think it'll be a really enjoyable and informative time. And finally, we'd like to ask you to take a quick survey, just 1 minute, 8 questions. This helps us make us more productive for future webinars and things like that. So I'll turn it over to Mike Rogers. Again, he's president of 360 Financial. He's been leading this firm since 1995 after spending 5 years with 2 large investment firms. Mike uses his 30 years of experience as a fiduciary to help implement customized strategies, investment plans, both for our clients and our many retirement plans that we manage here at 360 Financial. So go ahead, take it away, Mike.
Thank you, Brian. Thank you for that introduction. And for the people who are newer to this webinar, Brian has joined us through a merger and is managing and leading the Oak River location that we now have. So Brian, thanks to you and your team for joining us this past year. And we look forward to servicing more and more of our clients as we expand out through the metro area.
Yes, thank you, Mike.
Yeah. And so as Brian said, we have a program today, and I'm going to start the screen share, which really looks at this aspect of looking at balance. You know, this past year, obviously, these rocks had fallen. They weren't on balance at all. You know, this is a Zen rock garden. It's supposed to represent kind of peace and tranquility. And instead, we had the opposite in 2022, coming off of a 2021 COVID year. So we think the titling of this, and we partnered up with LPL Financial, who is the brokerage firm that holds our clients' accounts and our custodian, and utilize their research department to come up with this idea of let's get back to balance. And so we'll spend the next, 60 minutes, maybe a little bit less, just kind of going through what does that mean? How does it impact you? Where have we been and where are we going? So this adjustment period that we're coming up on, it's going to be pretty crucial for us moving forward. And so we just want to jump into a number of the different topics that are probably top of mind to you right now. First of all is the economy, both the global economy and the U.S. economy. So from a global perspective, we think the economic environment is going to be pretty slow globally. And so when we look specifically at, areas like the international markets, it used to be you were anticipating about 2% growth rate. We look for that to be 1%. Okay. A lot of it does depend on China. China is now going through some changes. Stock market's starting to show a little bit of positivity finally after all this time. But the big changes that they're going through is this lockdown easement. They've been so strict on their COVID lockdowns that we think as they're easing that's going to be good for the Chinese economy. Certainly has to be. Should also be good for the U.S. economy because of goods and services, especially goods that we get from the Chinese market. Okay. The other thing that I just thought about here recently is the opening up of travel might allow some of the Chinese, not in the grand population, but at least at a start, the ability to receive better vaccinations. And that's been one of the issues that they have in China, is that the vaccination program that they have hasn't been very effective. And so, there's a lot of positives potentially in some of those areas. Europe and Germany still are in a scenario where we're looking for, some potential problems in those areas. Now, we're not completely against them. And as most of you know, in our accounts, we haven't had much money, if any, in international stocks over the years, both emerging markets and the developed markets. But when we look going forward, here's kind of what some of the GDP predictions are. How fast or slow is the economy going to grow? And is it going to be in a recession? So the United States, we're looking for growth at very, very flat rates. 0.5%. The Eurozone slightly negative. That would be recessionary. Some of these advanced economies on an international basis at 0.4. So you can see everybody's pretty much in the same ballpark until you jump into these emerging markets, and you have the potential for much higher growth rates in emerging markets. And I will warn you that the emerging markets tend to have higher growth rates predicted. And the last few years, they haven't realized it. And part of it is because of these COVID lockdowns that came out of China. And so globally, you're looking at, a sub 2% growth rate, including that big pickup in the emerging market area of 1.7. Over on the right side of that screen is kind of what are we expecting from inflation. Okay. And you'll notice that CPI, and we have some CPI numbers coming out this week. So this is going to be a pretty interesting start of the year. We also have the start of earnings season. So we'll start seeing fourth quarter data come in from US companies about their earnings. But CPI is the big factor that we've been tracking. And if you recall a year ago, we had some really big headwinds. And higher inflation was a headwind measured by CPI, got up to 9% range on a year-over-year basis. Higher oil and gas prices were a headwind. So we saw a lot of inflationary prices just at the gas pump because oil went from $70 a barrel to $120 a barrel. Okay, and then another headwind that we saw was this spike up in interest rates. So we had a lot of headwinds in 2022. And we frankly think that some of these are going to start turning into tailwinds, especially when we look at inflation is coming down on a month-over-month basis. And we think that's going to continue to drop. And get more in the 3.5% range on a year-over-year basis. Not the 2 that the Federal Reserve is looking for, but still lower than what we see in most countries. And the issue with inflation that we just have to be careful about, like in Germany, as an example, they seem to still be accelerating in their inflation numbers, and that makes it very difficult, as we saw last year, for the economy to prosper. And it makes it very difficult for the consumer. So we'll talk a little bit about that as we go a little bit further into the US markets. Okay. So forecast for this coming year is we are looking for inflation to moderate, and we're looking for very, very low economic growth. Okay. One reason that we're seeing this healthy debate on are we going into a recession or not is this chart right here. I'm like, well, what is that chart, Mike? Well, basically what it's trying to track is leading into economic indicators, and that activity within these leading indicators to show if the economy is growing or the economy is shrinking. Okay, and so you'll notice, see if I can get my highlighter to work here. You'll notice that we're in this scenario where that should work, where the leading indicators are starting to turn negative. Okay, and so when we've had this in the past, it has been in recessionary times, and so the people out there that are talking about recession and talking about the decline in the economy are really looking at aspects of like this leading indicator area. Okay. There's certain areas that this impacts more than other areas. Housing, for example, is very, very slow. And their starts have come down considerably. The Federal Reserve would never come out and say this directly, but they are trying to impact the housing market by raising rates as much as they have. Mortgage rates have doubled over the last year, and that's a direct reflection of, the 10-year government bond going up past 4% in the fall. Now it's sitting at about 3.6, but it's definitely an indicator of where the recession is going. So, when we've had drops like this in the past, it has led to a recession, and this is a pretty substantial 6-month drop that we saw this year. If you're going down this line right here, so we got to keep an eye on that. Keep an eye on the leading indicators. We'll see more of that data come out first quarter, so we'll be kind of watching that, of course, as well. Okay. It also leads kind of this fact of this unemployment picture, and so now I will tell you that we've never gone into a recession when unemployment is falling. Okay, so again, you can look at leading indicator data like we just did, but if we look at unemployment, we see very low unemployment. As a matter of fact, here in Minnesota, our unemployment rate is at 2.3%. Now it did get down to 1.9% in the summertime. So we're at 2.3. Nationally, we're at 3.5. And what this chart is showing you is not unemployment rates, but it's showing the openings for unemployed individuals. So basically what it's trying to reference here is that there's 2 job openings, get this to work, for every person who's unemployed. Okay, you can see this huge increase. And so, there's 3 things that are going on here. That the ratio of openings to unemployed 2 to 1, that's a big ratio. The number of those that are just not in the labor force, there's a number of people that just left, and I'll talk about where they went in a second. And that leads to this third aspect is companies like ours or big organizations like General Mills or Medtronic, are having a hard time finding people. Okay. Well, a lot of times, I'm sure Brian gets the same exact questions. I get the question, well, where did everybody go? If unemployment's at 3.5%, which is about the same as it was before COVID started. So if unemployment's at 3.5%, where did these people go? And the Federal Reserve earlier in 2022 did a report that they came out, published a report that they came out with and said, here's where everybody went. We already know the answer to this. People went to one of 2 places. They either retired early because they could, they figured, or they should, with one or the other, or there's this big jump up of people that were taking care of family members or friends at homes or in, at their own homes or in their family members' homes. So we saw these people leave the workforce. And just think about it logically, how many people could not send their kids to school or daycare? And a lot of them haven't come back into the workforce. So it's one of those areas in the economy that we're going to keep an eye on because of the fact that it's pretty important to get these people back in here working if we're going to have a growing economy. Okay. The other aspect of the economy that we're going to keep an eye on, I mentioned it earlier, is housing. Okay. Believe it or not, about 1/3, of people's income goes towards housing costs. And so housing prices are going up. Okay. But overall costs are starting to drop. And so what I mean by that is housing prices had been going up, but the cost of renting is starting to slow down. It's starting to decrease. The price of housing is starting to come down. Now, mortgage rates have gone up. They're not down where they were before. They've increased. But if we can get, especially for people who are renting, we can get this drop in home spending on that sector, that does free up other discretionary money, and it should also be pretty good for the consumer because they're putting less money into their housing budget. Okay, so that's a few different aspects as far as what's going on with the economy that we think is important for us to keep a look at as we go into this year and further into it.
Hey, Mike, I think a good question would be on people's mind, and I've been talking to a lot of my clients, is what are we waiting for? What is the Federal Reserve or Chairman Powell waiting for to stop raising rates or at least pausing rates? He keeps saying he's data driven, but can you share with the folks on the webinar today about some of the data points that he's watching and we're watching for our clients?
Sure. Yeah, absolutely. It's great. It's a great point, Brian, because with the housing being just one aspect of it, but when the Federal Reserve and Powell is they're looking at a number of different, I think, data points. And we've talked about this a little bit at our investment committee meeting that we hold every other week here at the office. They're looking at, first of all, wage growth. How fast is that growing? And so if unemployment continues to trend downward, and we still have this big gap of the need for workers, it seems logical that wages will have to increase to attract those workers back into the workforce or to jump ship into another company. So they're watching that really closely. They're watching, kind of the manufacturing index to see if that is starting to slow down or pick up. And if it slows down, that shows that they're starting to see some traction on their policies to slow down the economy and to slow down, hopefully the inflation data. And they're also looking at housing starts, in the housing market specifically. And remember, when rents are declining and housing starts are declining, that impacts a tremendous number of areas of the market, of the economy. If you buy a new house, you go out and you probably buy new furniture, buy some new appliances, paint some walls, get it to feel like your home. But if you don't make that change, then none of those purchases occur.
Exactly.
So does that help answer that question?
Yeah, I think, and we also are looking at our government spending, the government's trying to grow the budget, try to spend more money, do more fiscal stimulus, but that's also inflationary. So I know we'll be talking about that a little bit later.
Yeah. And part of all the change that we have been going on, we'll talk about that in a minute, how that might impact. It's a great point. And how does it impact what's going on in the in that environment? So let me go to the stock part of the portfolio, and I've covered the economy. We'll talk a little bit about what's going on with the stock market. We do think, if you look at everything, we're looking at the stock market increasing in 2023. There's a couple of things here that we believe will happen. And one of them is that the Fed will at least pause on increasing their interest rates. Okay, so we think that will happen sometimes first half of this year. That's typically, and I'll show you some charts in a minute, that's good for the stock market. We also think that, as that's occurring, we'll get some better results because people will be less worried about inflation. So we're looking for inflation to, as I've already mentioned, to start, kind of trending downward. So when I look at specifically the stock market, and we look at, what happens after a rate cycle increase stops. In other words, the Federal Reserve just stops increasing interest rates. And you can go back to 1974. There's 9 occurrences here where the Federal Reserve had to, they were increasing rates and then they stopped. And then we look at the stock market on the flip side of that coin, say what happened to the stock market. Okay. On average over here on the right-hand side is 12 months later, the stock market's up about 12% historically. Okay. And the reason is logical. If you think about it, basically, what the timing of the last rate hike is when the Federal Reserve feels that they've done their job, and say they stop doing that. And the stock market says, okay, we're projecting out that the economy is going to be stronger in the future, and stocks therefore perform a little bit better. So, that's what we have as far as the projections. And then you'll notice it's not every time that this happens. Back in 2000 during the dot-com bubble, the Reserve stopped increasing interest rates and the stock market continued to drop. Back in 81 and back in 74, you had scenarios that were very similar. And so what we're looking at here is saying, again, historically, 6 out of 9 times the stock market has gone up after a stoppage of the rate increases. We think this time is not different. We think that we'll have similar type of bounce back in the market. And there's another reason here, just logically, is when the stock market has a down year, it typically follows by an up year. And I know that's very simplistic, and again, this time could be different, and it absolutely could. But generally speaking, when we go through this chart here, the blue lines are the down years, so the blue bars. Obviously they're negative, and the orange are the S&P 500 rate of returns the following year. And so you'll see very infrequently do we have back-to-back negative years in the S&P 500. And of course, it can always happen. But on average, you get somewhere in here of about a 15% rate of return after a negative year on the positive side of the following year. Okay. We know that the S&P 500 was down about 20% this past year. The Dow Jones was down 9%. The NASDAQ, which is tech heavy as far as the type of stocks in that index, was down 33%. So definitely had a negative year with lots of red, if you will. And so, that positions well, I think, for 2023. Now, I will tell you that, the only way you can get these positive years, and as you look at this, again, you might be like, okay, well, how many negative years and positive years do we have? But out of the last 18 negative years, the following year, 15 of them have been positive. Okay. It's also the hardest time to be an investor. because you are going against the grain. You are going against the negativity that's out there and is so strong out there that this year is going to be another horrible year. And it could get worse before it gets better. We don't know the timing of this, but we do still historically, as Warren Buffett says, when you're buying when everybody is fearful, when the markets have gone down, that's when you tend to make the most money if you have at least the ability to look at it longer term. And you have the ability, I guess, to be a little bit courageous when you're purchasing against, the quote unquote trend of what a lot of people would be telling you to do. So I think there's some good opportunities to be investing into this market. Okay. Despite the fact that earnings are coming down, and the consensus on earnings is dropping. Now, it's not negative, but LPL and their research department, they're looking for the S&P 500 this year to generate about $220 in earnings. So it's this flat line right here. Okay. What this chart is showing you is the consensus earnings for 2022 and the consensus earnings for 2023. And you can see they both are trending downward towards this 220 marker. Okay. And one reason the stock market was down, just one out of many, was because of this trending downward effect. Remember, stocks over time follow earnings. And if earnings are going down, stock prices will tend to reflect that. Okay. But also remember, the stock market is anticipating 6 to 12 months ahead of us, into the future and what they think earnings are going to be and what, issues might be coming up for the economy. Okay. So, we do think that revenues will probably get a boost, and not go, below this 220 number. And that revenue boost is going to come from companies that could raise their prices. Okay. And then the key that we're going to be really trying to track is how are the earnings doing, besides the revenue. Did their margins get squeezed even though they were able to raise their prices? A number of clients ask me, hey, Mike, are you going to raise, the fees that 360 is charging, because there's so much inflation, and we're not doing that, but you and I see increased prices in a number of different areas. And so as inflation again starts to come down, prices start to come down, that should help the margins of some of these companies. Okay. So we don't think, again, if you're writing down notes, we don't think there's an earnings recession on the horizon. And slower earnings, but not a recession, not negative. And so if we look at kind of where we're at here, when we look at, is there a chance for a recession? Is there a chance for the economy to grow fast? We're basically in this middle camp right here. Okay. And that is saying that, inflation will ease. We'll have interest rates gradually lower, not substantially lower. The only way you're going to get substantially lower is if you think we're going to go into a deep recession and now the economy has to pivot and the Federal Reserve has to pivot and start decreasing interest rates. Okay. So the Fed starts pausing here in the first quarter or second quarter of this year. We have earnings growth. Okay. We have a pretty stable geopolitical environment, with China hopefully improving. They're basically in a recession now, and hopefully the Ukraine-Russian situation comes to some sort of conclusion. You remember February of last year, that was another uncertainty of what was going to occur there. Still uncertain, but it's been a much longer and hard-fought battle by the Ukrainians than pretty much anybody expected. We're looking for modest price to earnings ratios, so not big discounts, so you're looking at basically about an 18 multiple. Okay. If we can get earnings for $220 for this year, that's right here. We can get earnings for $240 for next year. That gives us a target rate of on the S&P 500 about $4,400 a share, which is about a 13% increase from where we sit today. If we can get up to this 4,500 target price, that gets us to almost up to a 16% increase. Okay. There's a bull case, that's a soft landing, and things really start to get back to normal, get back to even a better balance than what we're expecting. And then there's a worst case scenario where we have a deep recession. Okay. And we have earnings, stagflation, inflation, and slow growth. We have lots of continued China tensions. We have, PE ratios at a 16 instead of an 18 multiple. That brings your S&P kind of estimates right in line with where we're sitting now. So we think in the middle is our scenario, our base case scenario. That's where we think we're heading for 2023.
I agree with you, Mike. I think that middle column, the base case, that's our highest conviction. That's what's the research is telling us. That's, again, a lot of the slides you presented earlier kind of falls within that base case. So I think as our clients look at this slide, I think those are the things that we should be focusing on and communicating with our clients throughout the rest of this year.
Yeah, I think it seems logical with all the data that we have behind it. The hard part about logic sometimes is in our business, it becomes somewhat emotional at times. And our job, Brian, yours and I, and all the other advisors that we have, 7 other advisors, and our entire team 360 is to help our clients kind of walk through that emotional aspect and try to just focus on, if you will, math. I like the mathematical aspect of it because I'm a finance major, or just the logic of kind of what we think should happen, and where we run into scenarios that really upset the marketplace or surprises, right? Black swan events, sometimes they're called, and they're called black swan events because you don't know when a black swan's going to happen. Believe it or not, it was 3 years ago next month that the world started closing down because of COVID. That was a black swan event, and the markets tanked in the month of March back in 2020 and rebounded. Took a little while, but it did make that back up throughout the year. And so the surprises are the ones that we really have to keep an eye on. The logical explanations of this base case seem to make a lot of sense. And I know we talk about our investment committee meetings. I would agree with you. It's a good place for us to be going in 2023.
Great.
So how about, the other part of the market, and that's the bond piece of it, and so we have stocks and bonds. Bonds had also a very difficult year, and interest rates jumped up dramatically from where they were a year ago. And we've got, again, kind of some different scenarios as far as what could happen with interest rates for this coming year. And that's a hard landing. Hard landing is basically a recession. So the economy shrinks, kind of like what we talked about before. And then the other scenario is stagflation, where the economy shrinks and we still have inflation, then maybe the economy actually just slows really low. So remember, our base case is the economy is going to grow slowly and inflation is going to start dropping more because the month over month data shows that. Okay. So we think, again, we're in this middle range, flat growth, potential mild recession if we go into one, or maybe a no growth type of environment. So the economy still grows, but it's very, very slight growth. Inflation starts to ease. The Fed, maybe even starts to cut rates in the second half of the year, but at least stops increasing rates. And then globally, government bond yields start to just stabilize, just like our yields will stabilize. Okay. So if we get into that environment, we're looking at, 10-year treasury being in the 3.25% to 3.75% range. So to put this in context right now, as of literally this morning, when I double check the number, it's 3.61% on that. So we're really no change. We're kind of right in the middle of that projection. And we think that's going to continue pretty much throughout the rest of the year. Okay. The current Fed funds rate right up here is, about 4.5% would make sense. It's 4.33%. The yield right now, what they call the expected yield. Okay. So again, pretty much right in the middle of that. Okay. Now this 4.33% or 4.5%, if that's where we end up for the year, is still as high as it's been since 2007. But it's not as high as it's been ever. So a lot of people are acting like the rates because, again, we look at short-term cycles, and say, well, these rates are really high. they're nowhere, of course, near where they were in the early 80s when we were paying mortgages of 15% and getting, money market rates of 12% at the bank. What's interesting about this is the Fed funds rate. We throw out that terminology all the time, and people ask me, and they probably do the same thing with you, Brian, and our other advisors here. What is that? What's the Fed? What is actually the Fed funds rate? And it's really just the amount of interest that banks charge each other for loaning money overnight. And so it's a barometer of short-term interest rates is all it really is. Okay. So what else can I tell you about this? Lower inflation, like we talked about. Not too much going on as far as the actual yields are concerned, is our thought. If we get into a hard landing, and the economy goes into a recession, the Federal Reserve will start cutting interest rates, just like they raised them so aggressively this past year. We believe that would be the case. Why wouldn't they just, turn on a dime and do the exact opposite of what they've been doing to try to get inflation down? If we go into a very deep recession and inflation just subsequently would drop because the economy has slowed down so much, they'll start moving in the opposite direction. We just don't see that happening. But if they did, rates would actually drop. And then the other environment, of course, is we still have inflation, and the Fed does not stop raising rates, but they continue to raise them, and therefore you get higher rates both at the Fed funds level, the 2-year Treasury level, and the 10-year Treasury level. Okay. So the other thing that's of interest is, remember the old teeter-totter, or I think some areas of the country call them seesaws, when you'd get on them as kids, your friend would be on one end and you'd be up in the air, and that teeter-totter you just rock back and forth. Okay. So think about that teeter-totter when you think about interest rates and bond prices and how they move together. So as rates increase, like we had this year, the price of a bond drops. And so for a number of years, we've had the opposite happen. Rates have been going down, 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 and bond prices have been going up. Okay, so this year we had the opposite. So just like when you were a kid, when you're at the low end, you're down by the ground, and your friend is up at the high end. That's what's been going on with rates this year, and pricing is probably a better way of putting it. So this chart here is just illustrating what happens when rates go down, the bond prices, and what happens to rates when they go up. Okay. So if there's no change, this is about the yields currently in different types of bonds. Okay. So if we don't think there's going to be much change in interest rates, this is about what you're going to get, we believe, out of the bond market as far as rate of returns. You take on more risk, like high yield bonds or junk bonds, you get better returns than if you're in treasuries. Okay, so the illustration here that's interesting, and this is exactly what happened in an extreme case this year, is when rates go up by only 1%, you can see the yields drop quite a bit because of that teeter-totter effect. If you think you're going into a recession and rates are going to go back down, there's a real opportunity to make money in the bond market if that's the case. Here's the problem. It's very hard to predict which way the interest rates are going to go because it's very hard to predict which way the economy is going to go. Again, not to always talk about Warren Buffett, but he talks about, he doesn't even have an economist on staff at Berkshire Hathaway because it's so hard to predict these sort of movements in the economy. If you like investments and you think things are cheap as far as investment opportunities, that's what you should be taking advantage of. But this is an interesting scenario, especially based on the heels of a bond market this year that was down 15%. And so, so we're looking really at here, you might get a little bit better yield out of these areas because a lot of bonds have gone down in price and they eventually will mature. And when they mature, as long as they, pay back the principal because they haven't gone into default, then, you get back that full price, or the par value of that bond. So there might be a little bit of opportunity, but mostly somewhere in this range is what we'd expect, which is a heck of a lot better than it was, a couple of years ago. If you're in a portfolio that holds 20 or 40 or 60% in fixed income, you now actually have a chance to make some yield on this type of allocation from the bond part of the portfolio. The last thing I'll just close on is, rates have been very low for a long time up till this year. Most corporations cleaned up their balance sheets, refinanced their debt, very similar to what you might do at a house. And you refinance to a lower mortgage. That's what a lot of corporations did. As a matter of fact, a lot of corporations overfinanced because they knew they could issue bonds and pay 1 or 2% interest on those bonds. And they could take that money and they could hold it in cash. And they now could invest that cash at 4% inside of a treasury. And you can do the same thing, by the way. 3 and 6 month treasuries are around 4.5% now in interest. But they can take that money, invest in the treasuries, and they're only paying out to their bondholders 1 or 2%. So their balance sheets are very, very clean. And the nice thing about this chart is basically just showing is how much corporate debt has to be refinanced going forward. And you can see basically what this is showing you is that there's very little debt refinancing going on until a number of years out. So we're in pretty good shape as far as the balance sheets for corporate America are concerned. And that's important because if we're counting on earnings to improve in 2023 and then 2024 a little bit more so, the less they're paying a debt load interest is the better. So
Mike, I think also this points out that you mentioned some corporations took on more debt, even though they didn't need it to facilitate their operations, but they were building up a war chest. And now when maybe certain companies are going to be at a discount, they can take advantage of that again. So, they could be taking on new companies or new mergers and acquisitions. So again, they can earn more profits in future quarters, which will drive up their stock price. So I think a lot of chairpersons and presidents of companies are looking for companies to purchase maybe at a discount now that some companies might be, less, at a discount or lower value. So just like our consumers did the same thing, right? They refinanced their houses and now they're very happy to be sitting on this 2-3% mortgage. And they love that they don't have to go out and refinance the mortgage because they love their house and they're going to stay in the house. So same thing with our corporations, did the same thing.
Yeah. And, and you bring up the housing market because obviously with the jump up in interest rates, a doubling effect. I mean, it's considerably different for somebody to pay, let's say 3% on a mortgage versus 6% as far as their monthly payment is concerned. So what slows down the housing market, of course, is the people that now are looking for housing and they're getting 6% mortgages. But you're right, most consumers, and if we go into a recession, it'll probably be because the consumer is reacting more negatively to inflation and potential for unemployment, but their balance sheets are actually in pretty good shape overall, just like the corporations are. Yep, great point.
Yep.
So that just basically gives us a nice field work as far as our placeholder, I should say, for where we're at within the bond field, and where interest rates are at. We do find in the 60-40 portfolio, 60% equities, 40% fixed income. It's nice to actually be able to generate some returns on that 40% piece. So let's go into geopolitical events a little bit, and we've had a couple of things going on. Obviously, I talked earlier about the Ukraine and Russian war and kind of how that's been going on. It's actually starting to become a little bit of a tailwind to the market instead of a headwind. We were so worried about what was going to happen to natural gas prices, which have come down here over the last months because it looks like Europe's going to end up with a warmer winter. So you had a lot of panic. Remember, these commodities can go up and down drastically. We had a lot of panic around what oil prices were going to be. So again, remember, gas was pushing $5 a gallon, and now we're down to $3. So that hasn't drastically changed. There's some tensions out there, as far as, with NATO supplying arms, really towards the Ukraine, warfare effort. It's really the U.S. providing a lot of it, of course, but, there's some tensions as well in China in Taiwan and what's going to happen with those, but I tell people typically a lot of these geopolitical tensions, either they don't develop into big events, like war, like Russia and Ukraine did, or they don't impact the markets that much. You know, um, we do get some vulnerability of inflation. And when we look at this chart, it does kind of give us a picture of what that inflation vulnerability looks like. And so there's two things going on here. It's China and their growth rate as a country and how quickly they've been growing and their consumption of commodities to grow that quickly. And then commodity pricing in general. So the blue line represents the Bloomberg Commodity Index, which is basically the pricing of commodities. And you can see it bottomed out here, right around 2018. And then we started getting this climb up, and we've heard all about it. Lumber prices have tripled, and egg prices and chicken prices and commodities in general have gone up, and oil is going to go to $150 a barrel. Well, oil's $75 a barrel today. Lumber prices are back to the same level that they were back in 2000. Chicken prices have gone down 70%. So we're starting to see this blue line trending downward. Okay, that's good for that inflation discussion that we just had. The orange line is representing kind of the pressures that the Chinese growth rate puts onto these commodity prices. Okay, and so you can see the substantial decrease in that because China has been in a recession because of their lockdown, and therefore there's less demand for all the commodities. So, from a geopolitical perspective, besides the war and the back and forth of what's going on there, this hyper growth rate by China that we've been facing for a number of years, decades at this point, has really slowed down, and that should actually help the economy to bring down, those sort of costs. So, Brian, any points on the geopolitical front?
I think we've learned through this pandemic and a lot of corporations that were relying on China to manufacture their goods, i.e. Apple, have now been trying to move their manufacturing plants to other countries to diversify that risk out of China. So I think, some of this slowness in China is being forced upon them because of these national companies, multinational companies are moving their plants to different parts of the country. And some of them coming right back to the United States. That's always been the push. But I think that's also going to help us go forward, that we're not going to be so reliant on China and their whims of their politicians and stuff. So.
Yeah. And they're just their framework of their government, right? And what they decide to do within that political environment, of course, so bringing it more instead of offshoring, onshoring is the terminology we're hearing a lot of now. Semiconductors is one area that everybody knows there's been a shortage of certain types of semiconductors. Taiwan makes the most semiconductors. That's why we do have a little bit of a concern about the China-Taiwan relationship, but even that aspect of that business is coming back into the U.S. to a certain extent. It takes a long time to build a chip factory, but at least there's talk and there's plans to do so.
Absolutely.
So, good point. So let's talk a little bit about policy, because we had an election change this year, or we had an election, I should say, and we had a change in the government this year. And so it's just, we've had lots of news recently about a new House Speaker and how long it's taken to get that kind of settled by the Republican Party. And, we had a midterm election back in November. And so the midterm elections are interesting because obviously the White House isn't being changed during these midterm elections, but what's up for grab is the Senate and the Congress control. And while there was not a red wave, like lots of people were predicting, what ended up happening at the end of the day is that the Republicans did get control of the House. The Democrats have control of the Senate and of the White House. So you have this shift of a balance in power, where everything was controlled by one party for a couple of years. They still had some infighting, so it wasn't like they could do everything that they wanted to do within the Democratic Party. But we had this occur, a few years back when the Republicans had full control as well. And so what you're going to find in some of the slides that I'm going to show is this shift actually is good for the markets. Now, I'm not getting on a political soapbox here. It's not the shift that the Republicans have some control, it's the shift towards nobody has complete control. And so here's the point that kind of gives us an idea of what I mean here. When we have a midterm election and we get it behind us, that's the most important thing, frankly, so that we can move on to the third year of a presidential cycle, which is typically the best year of the four. Might not be this year. We got a little caution on that. But what this chart is showing you is 1-year rate of returns after midterms. And look at no matter who's in office. And so again, not trying to be political. We're just looking at the data. And the data basically says that after midterms, Republican is president, stock market since 1950 is up 14.8%. And if a Democrat is president, it's 14.5%. And the average gain falls in the middle at 14.7. So what you always know is going back to 1950, it's no negative number. Okay, so it doesn't mean, again, that we will for certain not have a negative return this year. But if we are looking at data points and saying, you know what, this seems like it's logical that we should experience the same sort of scenario, okay, where we have a positive market. So we have a positive market because of the other factors that we talked about, and now we have the midterm elections behind us. And it seems like that's the most important aspect of this if you look at the returns. Okay. Here's a little bit of note of caution that we talk about with this one is the third year of a presidential cycle tends to be the best. We know that historically. Okay. And a lot of the reasons it's so good is because the government is providing a lot of money to get into the economy. Controlling party has a vested interest to make sure that the economy is roaring along so they get reelected. Okay. There's probably going to be more conflict this year, especially now with these, dual control of the governments between the Republicans and the Democrats. More conflict as far as spending and how much to spend. And as a matter of fact, one reason that it took so long to get a new Speaker of the House appointed was certain parties, certain members of the Republican Party really wanted to focus on fiscal responsibility and spending less. So we're just throwing that out there as a little caution, just because past years have been really good in this third year of a presidential cycle. We might not get that same effect because we're not going to get the same effect of the sale and the wins and the sales, so to speak. Okay. Here's another interesting slide when we get into policy. And if we look at just the rate of returns in a mixed government versus a one party government. And so for essence of time, this basically point out that, when we have a scenario where the party is mixed and there's nobody with complete control, both with a Republican president and a Democratic president, the rate of returns are substantial. And so again, we're hoping for this to show itself again this year and to be repeated. You actually get lower rate of returns when one party has complete control than when there's if you will, a gridlock. So gridlock is good because it keeps one party from doing kind of whatever they want, which may or may not be beneficial to the economy. So I think, Brian, there might be a point or two that you have here, or are you good with?
Yeah, I think it's going to be interesting to watch, as you mentioned. Obviously, the White House the president's going to be running for re-election, or a new president will be running for re-election. Obviously, the House all has to rerun in 2 years. A third of the Senate will have to, and so these politicians want to get re-elected. And like you mentioned, they want to keep the news on the front page of the paper looking very positive because that helps their constituents to re-elect them. So yeah, but they also, if they spend a bunch of money, then we're fighting the inflationary impact that our government can cause inflation by overstimulating the economy, pushing this, printing more money at the Federal Reserve level. We experienced that in 2020. Obviously, that's why we've probably had this inflation. So again, it's that tough, that is there going to be that struggle, and it'll be interesting to watch how they can manage that in Washington on trying to get reelected by stimulating the economy, but not also causing more inflation or more pain of inflation.
Mhm. Yeah. Yeah, and that's going to be the struggle going forward. I kind of pull out of this, and what you just said too is sometimes what this is telling us is maybe the best government is the government that governs the least. And here in this environment, we get the least amount, quote unquote, done, and it generates better market returns, and the economy tends to reflect that as well.
And something I always share with my clients, it also gives the corporations, kind of the rule books are not going to get changed on them because nothing's going to get passed. So that means they can go out and make decisions what's best for their company and best for their shareholders without worrying that Washington's going to change the rules on them and pull the rug from underneath them. So that's why we like sometimes, or Wall Street likes gridlock, because the rules can't get changed and now they can just plan like a good corporation should be planning for.
Mm-hmm. Yeah, that's a great point. Status quo, as far as those rules are concerned, and that's definitely advantageous when you're trying to do any sort of shorter or midterm planning over the next year or two.
Yep.
Okay. So I know from the standpoint we've I don't know if Charlie's going to jump back in here, but for this part of the program, Brian, you want to take it from here?
Yeah, Charlie can come back online and see if there's any questions in our chat box. Maybe you could start there, Troy.
Yeah, definitely. We do have a couple of questions. One was back when we were talking about stocks. Someone asked, what will happen if Congress does not increase the debt ceiling this summer?
Mike, you want to?
Well,
yeah,
I've been doing this long enough where this conversation and topic has come up many times. And I guess what I'll tell you is that they probably will increase the debt ceiling because they always have. But what we might start hearing is a lot of noise about they're not going to this time. This time is going to be different. If you get some weakness in the stock market because of the politics of the debt ceiling, talk to your advisor. If you have that might be a good opportunity to take advantage of it. But typically these political events like debt ceiling create noise. They don't necessarily create long-term market movements. So we think that would be the same this time around. Brian, would you agree with that?
Yeah, I think it's going to be that, shutting down the government, people, getting furloughed, government employees getting furloughed, which is never a good thing. And again, it's going to be the noise on the front page of the paper, and then finally, some backroom deals happen in Congress and, we wake up in the morning and they've signed a debt ceiling or an increase in the debt and we move on. And it's just, again, a news cycle that comes and goes.
Mm-hmm. I think we'll hear more noise about it this year because of the changes that we just saw over the last week as far as the House Speaker election.
It took them 15 ballots, so obviously it could be something going on with the debt ceiling too.
Yeah. That happened 150 years ago once. So it's pretty rare occurrence. We're living in history there.
Yeah.
We do have one more question. I will encourage others to, type in your questions either in the chat or the Q&A section. If there's anything you guys, anything that you guys want to have Mike and or Brian cover. The remaining question we have here is, there's been a lot of talk about changes to retirement and distributions. Somebody's asking a question about Secure 2.0. Can you elaborate on that?
Yeah, this is
go ahead, Brian.
Yeah, this is a new, Congress passed a new bill called Secure 2.0. We're just diving into it right now. There's a lot of details in there, but it's going to do some changes to the retirement plans, 401k plans, what we call required minimum distributions could be changing. So it's a great webinar that we're going to put together for our next one here coming up in the later of 2023. So stay tuned. We'll get you more details in Secure 2.0.
I was just going to say, stay tuned. Lots of details and information for us to hash over and make sure that we can present it all to you. So whoever asked that, we'll have another program for you. We'll go through it all in detail and how it impacts you and how it might not impact you. Sometimes it's more important to know.
Yeah.
Right. Well, I want to say thank you all for your time today. We will be emailing out a recording of the webinar. So this concludes the Outlook 2023. If you're interested in speaking with Mike or Brian, Emily Moore, our client development manager, will be reaching out with the scheduling link. But if you're interested in learning more about 360 Financial and our proven life wealth process, high-level view of our AQ investment strategy, please stay on for a few more minutes, and we will walk you through that. So thank you again for your time. If you have any further questions, we are here to have a conversation and be your sounding board. And we'd love to help you out right now.
Thanks, Troni, and thanks for especially for people who aren't familiar with 360 Financial. You know, whether it's because of the new merger and Brian's clients are joining us and coming underneath the 360 umbrella, or clients have been with us for 27, almost 28 years, or if you're just brand new to our whole process. We're going to talk a little bit about how the process works. This will only take a few minutes, but we really want you to leave here knowing that we have, make sure I can get this thing to move forward, that we have a process in place that I'm back, and show you kind of how it works. And so not sure why my screen is not moving. So I'm going to double check something here. There we go. Let me click on this. Okay, so there's some disclosures that we're always supposed to show you whenever we do a webinar and we talk about investing and then our financial planning practices. So this is basically risk is always associated with different types of investments, and investments do go up and they go down. There's no insurance on investments, of course. And so talk a little bit about what our process is and how it works. Okay, in a broad view, we know that we can focus on a few things with our clients. And the most important thing we can focus on is building a customized and personalized plan that's focused on exactly what matters to that person or to that couple. Okay. And we're going to focus on these whys. Almost everybody that we work with wants to focus their plan on their family, their occupation, you know, whether that's career bound or maybe something beyond their career and what that looks like, and their recreation. How do they want to spend their free time? You know, and that could either be, again, in retirement or as they're working their way towards that retirement goal. But when we're building plans and we're building strategies, it's all around this aspect of family, occupation, and recreation. We take notes based on family, occupation, and recreation. We put together game plans based on family, occupation, and recreation. And then what we do is we interlay, if you will, the how to the plan, and that's the money. So we have an acronym. We use it every week at our team meetings. It's called FORM. And we talk about FORM within our investment policy, our investment committee meetings, but especially in our team meetings. And so the money aspect is the driver, if you will. It's the gas in the engine. You know, we don't see it as the end all be all, but it is the chassis that delivers the results to what the whys are. Okay. So as we're going through the planning process, we really want to focus on what we can control as well. You know, so Brian and I just spent 55 minutes going through the economy, going through the stock market, going through bonds and interest rates and how they move, policies, a lot of real big picture data points. You know, a lot of that, frankly, we just can't control. That's our logic. That's what we see happening going forward. What we can control is what we really need to focus on. And those aspects are, what's our philosophy? You know, do we panic when the markets start to go down? Do we stick to a discipline? What's our planning strategy? Ours is based on 3Ds: the discover phase, figure out what's important to you and what matters, the design a customized plan so that we can put it in place and deploy it for you and your family. And then we follow that process on an investment front and on a planning front going forward. And it's real simple. If we can combine this Venn diagram to focus on what is important and what matters to you, what we can control. And the sweet spot there is what we call our life wealth plan. And the life wealth plan is putting all of this together into one organizer, whether it's a binder or electronically, and coming up with one place to have available in case anything would happen to you. But it saves you time, saves you emotional energy, and it puts together concrete steps to where you want to go in your planning process. So, I don't know, Brian, if you think I've missed anything along those lines, please jump in.
No, I think it does a really good job of kind of setting us apart from what other, experiences might be having out there with other planners.
Yeah, I agree. And we've built this over the years to really look at how can we manage your, as a client, impactful financial events. And so those impactful financial events could be anything from retirement, and a retirement paycheck up here on the top, kind of right side of this circle, the 360 circle, to tax strategies. And that includes, tax changes, tax preparation, how do sale of assets generate additional taxes? When we look at investments, as I'm working my way around the circle, that's an impactful event. We just went through a bear market. And unfortunately, we all have now an MBA in bear markets if you didn't have one before. And so we have to look at things like recessions, like I just talked about. For a lot of our clients, executive compensation falls under this investment vehicle because they get lots of incentives on stock options. Family security is one that I really enjoy spending a lot of time on because I have 6 kids. And I think it's one of the most important aspects of our planning is how do we set up the matriarch, patriarch, if you want to use those terminologies, but mom and dad, to leave a legacy that falls into this next part of the investment impactful events or financial events that make an impact. And then for some of our clients, and most of our clients are either professionals that are really busy or business owners that are really busy, and they want to delegate this sort of strategizing out to an experienced financial advisor. They might be selling their business, or at least getting the next generation involved in that business. And how does that look? So you can see all these impactful events can be different and will be different for each one of our clients. And that's where the expertise comes into place as far as how do we pull it all in together. Okay. And it does mean we have to invest money, to meet to those goals. Again, aspects. So we do all the planning and then we look at the investment piece. And so our investments really are based on a 2 structure type of process. We look at the foundation of a portfolio, and then we look at the leadership in the markets, and we try to have money invested into those areas. So the foundation is literally that, like when you're building a house, what bonds do I own or bond funds? What types of innovative companies or funds, low cost exchange traded funds might I own? Who are the dominating type of companies in different industries that I might want to own within my portfolio? Who pays dividends so that I can get that income and reinvest it until I'm ready for retirement, or I can use it in retirement as income? And more importantly, maybe who pays dividends, but they also tend to increase their dividends because they have such good balance sheets. So that's our foundational approach. And depending on how much risk you're taking, you'll have more or less in stocks and bonds, and we'll be able to customize that for you. And we overlay on top of that what areas of the market seems to be doing well. And this is what we talk about every other week at our investment committee meetings. We go through all of these investments and we rank them, and especially on the leadership front. And if there's a time where housing seems to be doing very well, we can own an exchange traded fund that invests predominantly in the housing market. Okay, that was one that we owned. We don't own it any longer. If we think energy is a good place to have money, if we think healthcare is a good place to have money, or semiconductors or infrastructure, some of the areas that we're in right now, then we can pick up very diversified baskets of stocks, ETFs, to help us drive this leadership approach. And then we monitor the heck out of them and make changes every now and then, not every single, time we meet as an investment committee, because that would be too reactive, but build a portfolio with good quality foundational aspects to it, and then layer in some of these opportunities that we think are available in the leadership part of the economy and or the markets. So I mean, overall, this whole process starts with what we call a fit check, and it's really just we've got a certain way of working, and you probably have a certain need, and so do they match up? And if they match up, we can kind of move along the spectrum and we can start organizing. We call this the go meeting. Start organizing your estate plan documents, your trust, if you have trust documents, your statements for your different investments, your tax returns. We start pulling together all this data. So now we can start putting together that customized and robust plan. And then as we move along this, now we've got to implement or deploy, as I talked about in one of the other slides, and get this set in motion to move it forward. And because no plan is any good if it just sits in a binder or sits in the electronic, file until it's actually implemented. And then you have to really focus on how do we review and realign that plan on a consistent basis, because everybody's goals change, and that's okay, as long as the plan's flexible enough to have those goals change. And a good plan has flexibility built into it. And so that's our process. Again, anything that I might have missed there, Brian?
Yeah, I think we want to create a plan that will work under any conditions. Obviously, the past 12 months, those conditions we weren't planning for, but we would have plans that were able to absorb those kind of, market conditions. And that's what we've been talking, before we joined 360, and it's going to continue to do what we're talking about. The names or the titles may change a little bit, but the conversations that we've been having for the last 15 years here will be the same conversations going forward. So yeah, we're right on doing that too, and going into the next cycle of the economy and people's lives. So things change.
Absolutely, they change. And one reason it made so much sense for us to get together and kind of join forces here is because we both have the same philosophy. You got to plan first and invest second. And if we're shooting at a moving target, in other words, we don't really know where we're going. It's hard to invest the money appropriately. So let's have a strategy and a process around investing. But before that, let's have a planning process, make sure that we're going in the right direction. And so, the big thing, that we talk to clients about is, if you're interested in this personalized life wealth plan, the first step is that fit step. It's just, let's have a conversation. If you're brand new to us, feel free to reach out. We will go through this process with you. We'll see what your needs are. You can ask more questions about how the process and the planning phase works. And if there's a good fit or a good match, then we can talk about what the next steps are. But there's never any charge for just a conversation. And in that conversation, we'll talk about how we're compensated, and you'll know exactly what that is and how that works as well. So if you want to do that, Emily, our client development manager, absolutely can reach out to you, and she will. You can call us on the phone, you can shoot us an email. So Troni, I see you're back.
I am back, and I believe that will conclude our program. No additional questions have come in. So I just wanted to thank everyone one more time for their time today. And Mike, thank you for the wonderful presentation, and Brian, the enlightenment in the commentary as well.
Thank you, everybody.
Yep, thank you. Thanks for joining us. Let us know how we can help.
All right.
Thank you.